In 2020, a German payments company collapsed almost overnight. Not because revenue slowed, not because customers left. 1,900,000,000 euros was missing. The money was supposed to be sitting in trustee accounts in Asia. Auditors had confirmed it. Financial statements reflected it. Investors believed it. Then someone asked the bank a simple question. Can you confirm the balance? The bank replied that the accounts did not exist. Not frozen. Not delayed. They had never existed at all. Wirecard was founded in Germany and grew quietly. It processed digital payments. It worked behind the scenes. It wasn't consumer-facing. That mattered. Payments infrastructure companies tend to be trusted because they feel boring. They don't sell dreams. They sell plumbing. Wirecard went public. It joined Germany's main stock index. It replaced older, more traditional firms. For many investors, that was enough. Inclusion in a major index suggested oversight. It suggested maturity. It suggested safety. By the late 2010s, Wirecard was considered a European tech success story. Not exciting, just reliable. Wirecard's business had two parts. One part involved processing payments directly in Europe. The other involved so-called third-party acquirers, mostly in Asia. These partners were supposed to process payments in regions where Wirecard did not have licenses. The cash, according to Wirecard, sat in trustee accounts held by third parties. On paper, this structure looked normal. The balances were large. But the explanation was technical. And technical explanations often go unchallenged. By 2019, nearly 1,900,000,000 euros was reported as cash held in these trustee accounts. That number mattered. It represented a significant portion of Wirecard's balance sheet. It supported the company's valuation. It reassured creditors. And it was never independently confirmed. Wirecard's financial statements were audited. Year after year, they received clean opinions. The existence of the cash was not verified directly with banks. Instead, confirmations were routed through intermediaries. Documents were provided. Letters were signed. Everything appeared orderly. This is where comfort enters the system. Auditors rely on controls. Controls rely on representations. Representations rely on trust. And trust compounds when a company has already been trusted for years. Nothing looked urgent. Nothing looked broken. So no one asked a basic question. There were warnings. Journalists raised questions about Wirecard's accounting. Short sellers publicly challenged its numbers. But the company pushed back hard. Critics were accused of manipulation. Authorities investigated the critics instead. This also mattered. When institutions defend a company, skepticism becomes costly. Doubt starts to look irresponsible. Wirecard continued operating. The stock continued trading. The reported cash balance continued appearing in financial reports until it didn't. In 2020, auditors were under pressure to finally verify the cash. Instead of relying on documents passed through intermediaries, a direct confirmation was requested. The bank was contacted. The response came back quickly. The accounts did not exist. There was no 1,900,000,000 euros. There never had been. The confirmation letters previously supplied were fake. Within days, Wirecard admitted the cash was missing. Trading was suspended. Executives resigned. The company filed for insolvency. A firm once seen as stable collapsed in less than a week. The collapse wasn't caused by a sudden theft. There was no dramatic moment when 1,900,000,000 euros disappeared. The failure happened slowly. It happened when balances were accepted without verification, when explanations were allowed to replace evidence, when trust replaced confirmation. Auditors didn't invent the money. They failed to confirm it. Regulators didn't move the cash. They failed to question it. Investors didn't create the fiction. They relied on it. Everyone assumed someone else had checked. No one had. Executives were arrested. One disappeared for a time. Investigations followed. Reports were written. Reforms were promised. But the money did not return. Investors were wiped out. Employees lost their jobs. A national corporate champion vanished. The most striking detail remained simple. A balance sheet listed €1,900,000,000 in cash, and no one confirmed it with the bank. Wirecard did not collapse because it was complex. It collapsed because something basic was never done. Cash is supposed to be the easiest asset to verify. It either exists or it doesn't. But once enough trust builds, even cash becomes abstract. Numbers begin to feel real because they are familiar. And familiarity dulls verification. The system didn't break loudly. It stayed quiet for years. The €1,900,000,000 was not stolen in a dramatic moment. It was created quietly on paper. And no one checked until there was nothing left to save.